anonymousretailer.com.
Hello, anonymous retailers. I'm Jason from anonymousretailer.com. Q1 didn't break anything. It just made everything less forgiving. And then just over a month before this episode dropped, the United States and Israel went to war with Iran. That's the context we're operating in right now. Not as background noise, as the defining variable of Q2. Everything I'm going to walk you through today runs through that lens. Cost structure, the consumer, the decisions in front of you, all of it being shaped by a conflict that isn't resolved and doesn't have a clear timeline. I'm not here to predict geopolitics. I'm here to tell you what it means for your floor, your inventory, and your margin. Let's get into it. If you were with me at the start of the year, you heard me say the market question for Q1 was simple. Is it worth the trip? And I want to be straight with you about how that played out, not just tell you I called it right. The broad strokes held, consumer spending continued, traffic didn't collapse. But what I did underestimate was how fast the middle got squeezed. It wasn't that customers stopped spending, it's that fewer purchases cleared the bar. The hesitation wasn't at the bottom of the market. It was in the mid-tier. The customer who used to transact without much friction started pausing, started comparing, started asking whether the trip was worth it before they ever left the house. That's a behavioral shift, not an economic one. And it matters because behavioral shifts don't reverse when the next inflation print comes in soft. They compound. Every month a consumer operates in deliberate mode, that becomes the new default. The economy getting slightly better doesn't return you to the customer you had 3 years ago. That customer has recalibrated. This is who they are now. The other thing Q1 confirmed is something that I've lived personally and watched catch a lot of operators off guard. There's a fog that sets in during the holiday season. The volume is real. The energy is real. And that exuberance, the feeling that you can go for it, that you should attack the inventory, leads to decisions that don't show up as mistakes until January when the bills are due. The cash that got rated in Q4 is suddenly very visible, and the momentum that felt inevitable in December is completely gone. I've done it. Retailers of all sizes have done it. The ones who felt the most friction in Q1 weren't necessarily in bad businesses. They were the ones that the fog got to. Q4 doesn't carry forward. It never does. Here's the final read on Q1 now that the data is in. February retail sales came in at plus 0.6%. Better than expected after a weak start to the year. The quarter closed stronger than it started. Department stores up 3%, clothing up 2%. The consumer didn't tap out. But here's what every economist covering that number said in the same breath. This data predates the Iran conflict. It doesn't reflect higher energy prices. It doesn't reflect the sentiment drop. It doesn't reflect $4 gas. February sales is a rear-view mirror reading. We're entering Q2 with the strongest monthly numbers in months and zero visibility in what the conflict does to the next one. That's the honest close of Q1. Stronger than feared, less clear than it looks. We have 3 variables that have actually changed. I'm not going to reset the entire macro environment for you. If you were here for Q1, you already know the backdrop. Inflation is stabilized above the Fed's 2% target, not falling, not accelerating. The labor market softened. February actually shed jobs, which is a different signal than what we were reading in Q1. Rates are on hold with no near-term relief in sight. What did change materially are 3 specific things, and I want to be precise about each one, because each one has a direct implication for decisions that you're making right now. First, tariff structure shifted legally, but the cost pressures didn't. Here's the simplest way to understand what happened. There were 3 layers of tariffs in play. The top layer, the broad Liberation Day tariffs from April 2025. These got struck down by the Supreme Court on February 20th. They were imposed under IEEPA, the International Emergency Economic Powers Act, and the court ruled that authority doesn't cover tariffs. Within hours, the administration replaced them with a new temporary layer, Section 122, a flat 10% surcharge on all imports capped at 15%. And that expires July 24th, 2026, unless Congress extends it. That's the piece that's uncertain right now. The bottom layer, Section 301, never moved. Those are the China-specific tariffs that have been in place since 2018. They survived the Biden administration, survived every legal challenge, and the Supreme Court ruling didn't touch them. They're embedded, they're durable, and they're not going anywhere near term. The cost structure your business is operating against didn't get easier. The legal structure changed. The embedded cost structure did not. The refund conversation is real for some importers on the IEEPA duties, but don't let a potential refund on past exposure make you lose on forward inventory decisions when 301 costs are still baked into your landed costs. Second, energy is back in the conversation, and the Iran war put it there. For most of the last year, energy was a non-event. Freight cost had plateaued, oil wasn't spiking. That was a quiet tailwind most operators didn't even notice because it wasn't making noise. It's making significant noise now. The U.S.-Israeli conflict with Iran has choked off oil supply through the Strait of Hormuz, a waterway that carries roughly 20% of the world's daily oil supply. Tanker traffic collapsed. Oil spiked hard. Gas crossed $4 a gallon nationally as of this week, $1 more per gallon than before the war started. That's not a forecast. That's where we're standing at the open of Q2. When oil moves, freight follows. When freight moves, your landed costs move. If you're buying forward right now, placing Q3 orders, committing to depth, your landed cost models were built on freight assumptions from a world that no longer exists. Those numbers need to be rebuilt before you commit. The margin compression doesn't show up on the PO. It shows up when the goods arrive, and the math is different than you planned. The sentiment effect is just as real. The gas pump is the most visible price in the economy. At $4 a gallon, consumers feel it immediately. Before it shows up in their budget, before it shows up in the data, it changes how they feel about every other discretionary purchase that's already happening. Third, the dollar firm. The dollar has been in a prolonged decline, roughly 18 months of softness. For retailers sourcing internationally, that quietly raised import costs in dollar terms. The dollar has now firmed. That stabilizes import costs on one hand, but also tightens global pricing competition. A stronger dollar makes imported goods more price competitive here and puts pressure on the pricing floor in your category. If you've been modeling with currency cushion built in, that cushion is changing. Run the numbers fresh before you commit to forward buys. One more data point worth naming. February wholesale prices came in at 0.7 for the month, 3.4% annually. Input costs are moving faster than consumer prices. That gap doesn't stay open forever. It either gets passed through to the consumer, absorbed into your margin, or both. Right now, most of it's landing on the operator side. Energy costs will accelerate that pressure in Q2. Tariff structure, energy, dollar, and wholesale prices confirming the squeeze is real. Everything else is continuity from Q1. So what is this environment doing to the consumer? Here's my read on the consumer right now. And I want to connect two things that are easy to read in isolation, but need to be understood together. The NRF is forecasting 4.4% retail sales growth for 2026. Before we take that number in at face value, ask the question their headline doesn't answer. How much of that 4.4% is real growth and how much is inflationary price increase? Revenue that comes from higher prices on the same unit volume isn't growth. It's inflation wearing a growth costume. And there's something else buried in that forecast worth naming. The NRF acknowledged the Iran war's impact on consumer spending was too uncertain to incorporate into their outlook. The 4.4% was built before the energy shock was fully in play. That number may not hold as the year develops. Same story with the February retail sales number. Strong on the surface, but every economist covering it said the same thing. It predates the conflict. It doesn't reflect $4 gas, sentiment deterioration, or geopolitical uncertainty. The best retail month in Q1 is a data point from a world that changed the week after it was collected. Their own data tells the rest of the story. That growth is concentrated at the top. Higher income households are spending. The mid-tier and lower consumer is pausing, taking more time to purchase or not purchasing at all. The high end isn't hesitating. Everyone else is being deliberate. That's the market your floor is actually operating in, not the headline. The Conference Board released consumer confidence data this week. The headline ticked up slightly, but underneath it, the expectation index declined. And consumers' 12-month inflation expectations surged to levels last seen when tariff anxiety was peaking in August 2025. Comments about oil, gas, and the war spiked across the survey. The headline looks stable. The underlying data is eroding. The Michigan Consumer Sentiment Index hit its lowest reading of 2026 earlier this month. Interviews completed before the Iran conflict showed improvement, but the 9 days after completely erased those gains. A broad swath of consumers across income levels, age groups, and political affiliations reported weaker expectations for their personal finances. That's not a segment problem. That's a widespread signal. And the labor market softening adds another layer. February shed jobs. Households that were feeling financially stable in Q1 are now recalibrating across a less certain employment picture and $4 gas on the way to work. That's the customer walking into your store in Q2. The threshold got higher, and it just got a notch higher again. In a normal environment, the purchase is almost automatic. Consumer wants it, the price is in range, done. That's not what we have now. We have a customer who has been living with elevated prices long enough that the recalibration is complete. They're not surprised by prices anymore, but the adjustment didn't make them more willing to spend. It made them more deliberate. Every discretionary dollar has more competition. Every purchase is being ranked. And here's the part that changes the job of your store. Discovery has moved upstream. Customers are not walking in to figure out what they want. That already happened on their phone before they left the house. By the time someone is standing on your floor, they know what they want, roughly what it should cost, and what its alternatives are. They're already bought in. They just haven't handed you the money yet, which means the store is no longer where the decision gets made. It's where the decision gets confirmed or falls apart. If your inventory depth doesn't match what they came for, the decision falls apart. If your staff can't speak to the product at the level the customer already researched it, the decision falls apart. That's what a higher threshold actually looks like on the floor. The environment I've just described creates 3 pressure points that every specialty retailer is navigating. They're connected. How you handle one affects the other 2. And here's how to think about each one. Decision 1. inventory depth commitment. The tariff conversation is going to tempt some operators to pull back on inventory as a cost containment move. When your landed costs are elevated and policy environment is uncertain, the conservative position feels like holding back. Pulling back on depth when your velocity is solid is a margin mistake, not a cost containment move. You're not saving money. You're creating stockouts that train your best customers to shop somewhere else. Let velocity lead. Your top performing category is turning in 60 days. That's not the category to go conservative on because of tariff noise or geopolitical uncertainty. That's the category to follow with conviction. Depth matched to demonstrated velocity. Uncertainty about policy is not a signal about that product. Don't let one override the other. Read your velocity and follow it. Decision 2. Open to buy under rebuild temptation. Q1 momentum faded as it always does after the holidays. Turn slowed, weak positions got exposed. The instinct is to reload, resist it. Most operators are using open to buy as a sales planning tool right now. That's the wrong tool for this environment. Open to buy is a cash flow tool. And in a tighter market, the distinction between those two things is the difference between a healthy Q3 and a liquidity problem. Before you reload, look at what Q1 actually told you. Buy to that signal, not your Q4 memory. Decision 3, promotional posture. This one is the quietest pressure and potentially the most damaging. Promotional drift is already sitting just below the surface across specialty retail. When one player in a category discounts, it creates pressure on everyone around them. The justification is always the same. We're just being competitive. Here's the reality. Retailers lean on promotion to create volume. In this environment, that's a margin problem you can't afford. Every transaction matters more now. Margins are thinner. The goal isn't to recover from promotional drift. It's to never trigger it. Don't respond to competitive pressure on inventory that is moving. Q2 is not a weak quarter. Weak quarters are actually easier to navigate than people think because you already know it's hard. You cut, you hold, you survive, the expectations are set. This is an unforgiving quarter. And unforgiving is harder than weak. We're just over a month into a war that has already moved oil prices, gas prices, consumer sentiment, and forward visibility. None of these effects have fully shown up in the spending data yet, and they will. The question isn't whether this environment gets more complicated, it's whether we're positioned to operate precisely when it does. In an unforgiving environment, demand exists, but it requires precision to capture. The customer is out there, the money is moving, but the margin of error on execution is thin. The mistakes that the last few years of volume and stimulus could absorb, this environment won't absorb them. And Q2 specifically has 4 volume events that can whipsaw a business that isn't paying attention. Easter, Memorial Day, graduations, the start of summer, 4 demand profiles hitting in sequence. Managed with precision, they build momentum. Managed with optimism, they build summer overhang. And October becomes a clearance problem that started right here. The ending always starts with downstream visibility at the beginning with inventory flows. The decisions you make now in Q2 determine what Q3 and Q4 look like. Get clear now. Overbuying when velocity doesn't support it, letting the fog of Q4 set your Q1 buying posture, all of those are available to us as mistakes right now. And all of them will cost us in a way that a genuinely weak quarter wouldn't. So operate at the pace the market is actually giving you. Let velocity create opportunity, not optimism. Control over aggression. Signal over aspiration. I'll see you on the other side of it.